Have you ever seen an ETF flashing a 60, 80, or even 100% yield and thought, wait a second, that can't be real? Welcome to the world of YieldMax ETFs. They promise jaw-dropping payouts that grab headlines and lure in income-hungry investors. But here's the real question: how can they afford to pay so much? Is it a genius strategy, or just Wall Street marketing with a shiny coat of paint? Today, we're going to break it all down, step by step, and by the end, you'll understand exactly why YieldMax pays so much, how the covered call strategy works, and what risks are hiding underneath those massive yields. Let's start with the basics. Covered calls are one of the oldest income strategies in the book. Imagine you own shares of Tesla. You like the company, but maybe you don't think the stock will double in the next 30 days. Instead of just holding the stock, you sell a call option. That option gives someone else the right to buy your Tesla shares at a specific price, called the strike price, before a set expiration date. And the best part? They pay you up front for that, right? That upfront payment is called the premium. It's basically rent on your stock. Now here's how it plays out. If Tesla skyrockets past the strike price, you're forced to sell at that price. You miss out on the monster gains, but you still keep the premium. If Tesla goes nowhere, or just moves a little, you still keep the premium. It's like pocketing cash while you wait. That's the essence of the covered call strategy. Steady income in exchange for giving up some of the upside. Sounds simple, right? But YieldMax doesn't just stop there. They take this playbook and supercharge it. Instead of writing options on regular stocks, they write options on leveraged ETFs, tied to some of the most volatile names in the market: Tesla, Nvidia, Coinbase, even Bitcoin. Leveraged ETFs are designed to multiply daily moves, often 2 or 3 times the underlying stock. That means when Tesla jumps, the leveraged ETF jumps even harder. When Bitcoin tanks, the leveraged ETF falls even faster. And what does more movement mean? Higher option premiums. Traders pay a fortune to bet on wild swings. That's where YieldMax cashes in. They scoop up those juicy premiums and funnel them back to investors as monthly distributions. The result is eye-popping yields that look unbelievable compared to normal dividend funds. On paper, it feels like free money. But you and I both know there's no free lunch on Wall Street. Those premiums don't come without risk. So why do the yields look so massive? The keyword is annualized. When YieldMax reports yields, they often take a single month's distribution and extrapolate it across 12 months. If a fund pays, say, 8% in 1 month, they annualize that to 96%. That makes the yield look enormous, even though the actual payouts can swing up and down depending on how the options market behaves. In other words, the headline numbers can be misleading. Yes, you might see months of huge income, but you can also see months where distributions shrink dramatically. Now let's talk about the trade-off. Covered calls work beautifully when a stock trades sideways or drifts slightly up or down. You keep collecting those option premiums and enjoy the income. But if the stock rips higher, you miss out on big gains. Remember, you've sold away your upside. And if the stock plunges? The premium income cushions the blow, but it doesn't protect you from losses. You're still holding the underlying ETF, which can fall just as hard as the market. And with leveraged ETFs, the drops can be brutal. YieldMax investors are essentially signing up for this trade. Give me cash flow now, even if it means capping my long-term growth. That's why you see such extreme yields. The market is willing to pay high premiums because volatility in names like Tesla and Bitcoin is off the charts. But that same volatility makes the funds risky. Let's put this into perspective. Suppose you invest in YieldMax's Tesla-focused ETF. Tesla stock is notorious for its wild moves. On any given week, it can swing 10 or 15%. Add leverage, and those swings get even bigger. The options market prices in that risk by charging sky-high premiums. YieldMax collects those premiums and pays them out to you. So yes, you might see a double-digit yield every month. But you're also exposed to the reality that if Tesla goes on a monster run, your gains are capped. And if Tesla crashes, you're going down with it. This is what makes YieldMax so attractive but also so dangerous. Investors see the income and think, this is the answer to living off dividends. But the truth is, those dividends aren't traditional company profits like you get from Coca-Cola or Johnson. They're option premiums. They depend entirely on volatility, trading demand, and short-term market behavior. That's why the payouts can be sky-high one month and far lower the next. Another important point, the strategy itself is sustainable in theory, because options trading isn't going away. As long as there's volatility, there will be premiums to collect. But the sustainability of the actual yields, those eye-popping percentages, is much less certain. You can't bank on a steady 100% yield forever. Market conditions change, premiums shrink or grow, and distributions adjust. So should you invest in YieldMax? That depends on what you're looking for. If you want explosive long-term growth, YieldMax probably isn't for you. You'll miss out on massive rallies in stocks like Nvidia or Tesla. But if you're someone chasing high short-term income and you're willing to stomach the risks, these funds can deliver serious cash flow. Just understand that it's not magic. It's not a secret recipe. It's simply monetizing volatility. Here's the takeaway. YieldMax pays so much because it's collecting option premiums on some of the most volatile and leveraged assets in the world. The more chaotic the market, the bigger the premiums, the bigger the payouts. But the cost is clear, capped upside and amplified downside risk. Those monster yields come with strings attached, and investors need to be brutally honest about whether the trade-off makes sense for their goals. So the next time you see a headline about a YieldMax ETF paying 90% or more, you'll know the truth. It's not free money. It's not magic. It's the covered call strategy, pushed to the extreme. And that, my friends, is covered call strategy 101, and the real reason YieldMax pays so much.